My $100 a month portfolio has finally hit over $5,000. Now, I don't know why I've been sitting on making this video for so long. I've essentially been tracking a journey of essentially dollar cost averaging $100 into the stock market for the past like 2 years now. If you've been on this journey, I appreciate it, but it's, even with this last market correction, still sitting over $1,000 or over $5,000. Along the journey, there's been plenty of dips. If you look at the year to date, you've seen there was a dip here, which I bought. There was a dip here, I bought. There's going to be dips along the way, but I made this portfolio simply to show you that you don't have to do much, and as long as you relatively safely invest your money in something like, the S&P 500, which I did, the VOO, Microsoft, Amazon, Apple, and Meta. And overall, this is like the market return that I've seen just year to date, not including the overall. If you know the whole journey of why I had to go off M1 Finance, they started charging fees, and I hated that. This is just to show you that over time, you don't need much, and it will compound over time. And here's the thing, I wasn't even active investing. I simply was dollar cost averaging, which if you don't know, you simply just deposit what you have over a span of a month, a year, 5 years, it doesn't matter. Just simply invest what you have. And I chose to dollar cost average into an ETF, mainly VOO, but you see there's a few individual stocks that I had to get my gambling itch, but I essentially just dollar cost average into an ETF. And what this does, it just simply diversifies you, because I didn't want to have to manage all on an individual stock. What if something goes bad, right? But if you're simply spread across the S&P 500, which is already the top 500, companies in America, I don't really have to worry. If one goes down, another one will rebalance it, and I didn't have to pick and choose. And that's why primarily I chose an ETF, and I would recommend anyone beginning on this investment journey to do the same. But overall, this portfolio is simply just to show and use it as an example for someone who's afraid or just getting started on their investment journey. And overall, this answers the 3 questions that everyone has starting their journey. How much should I invest? What should I invest in? Or when I should get started? For how much you should get started with, it's literally whatever you have available. Now, of course, you're going to have to pay off your debts and pay off your living expenses, but whatever's remaining, as long as you have a decent savings and you're working towards that, whatever you want to invest, ideally you could start in something like a 401k or an IRA, but with your taxable income or whatever's taxable remaining, you can invest whatever you have. And just to show you, I did it with $100 a month. You could have done it with $50 a month. Some people do it with $500 a month. All you have to do is get started. And if you think that you need to buy an individual share, there are things like fractional shares, which you can buy half of a share this month and the rest next month. You can build up over time. And that's essentially what I did. And this even answers when you should start, literally any time. Now, of course, there's sayings like the best time to plant a tree was 20 years ago and the second best time is today, but literally start today. I started this challenge just to do it. Like, I wanted to show you, you don't have to, care about it. You could just set it and forget it, which is what I did. I literally forgot about my portfolio a few times, and I could have done this with like $50 a month just to show you over time and set the bar to be like $2,000, and it would have had the same results. I literally would have fractionally shared, dollar cost averaged, and built up a small portfolio over time. During this entire time, there have been corrections. Stocks have gone bankrupt, stocks have IPO'd, but overall, that's why I chose to do an ETF like the S&P 500. If one goes down, there's 499 to pick its place. And there's so many things when it comes to stocks that so many people try to be smart with individual picks. You're going to have an itch. You're going to have a gambling itch. And what I did is I chose individual stocks, and I chose, the top ones, the Apples, the Microsofts. But that was just an easy way for me to satisfy a requirement that I've been wanting to do. But at the end of the day, you can invest how you want. I just chose to do it like that, primarily into an ETF. Overall, you can choose how you want to invest. I primarily just chose an 80-20 route, with 80% being into an ETF and 20% being in individual stocks. Realistically, I could have chose 100% to be an ETF. I think when I started this challenge, it was all in VTI. But whenever the M1 Finance situation happened, I chose to go more growth or more risk with just the S&P 500. And that way I split it up after the fact. Now, you can invest however you want. At the end of the day, it doesn't really matter as long as you're choosing to invest in something smart. And lastly, for the bare bones beginners, what you should invest in is literally just that. An ETF. You shouldn't have to think about it. You don't have to gamble. You don't have to risk anything. An ETF is a well-established collection of companies. Now, this is going to be the VTIs handled by Vanguard. It's going to be the VOOs, the SPYs, the well-established ETFs that have been around for decades, have minimal fees. And when you're thinking about this, VTI is literally the American economy. VOO is literally the top companies in the American economy. you don't have to worry when it comes to that case. And if you were to zoom out and look at the collection of return that these companies alone have provided, they've always had record profits. They've always been all-time highs each year. I think Apple's like at a $4 trillion valuation. It's going to hopefully continue to make this return, because at the end of the day, there are people behind these companies. They still want profits. I mean, realistically, if you're trying to time a crash, it's likely not going to happen for you. So over the long term, just buy when it's up, buy when it's down, and dollar cost over for the long term. And even if this isn't an example, you can literally look at someone like a Warren Buffett who preaches the same thing.
I think it's the same thing that makes most sense practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in one century. And then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8%, and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
If you have any other challenges you want me to look into, let me know down in the comments below. And if you like this content, don't forget to like, subscribe, all that. Peace.